Kalau sirta tayo Oikonomika. Parakalo. Good afternoon, everybody. From Greece we love. Welcome back to Oikonomika, all about economics and finance and all the rest and all in between. A sandwich and a bit of ouzo. Ouzo, no, it's a bit ouzo. I like some very cold ouzo on a 40-degree Greek island. Right. Okay. So what do we got here? So today we're talking about the euro-dollar exchange rate. Why it's gonna happen? Why it's gonna what is gonna happen? What is happening already? Because we have the United States agreement with Europe, like 15% tariffs, sort of. Although we don't know exactly for each and every industrial sector, manufacturing sector, this, that, and the other. And so what's going to happen automatically is going to happen that what we see now is we have this big red body candle, which means that basically the market also, I mean, those who manage the hedging risk for big multinationals and investment banks and stuff like that, those that manage commercial transactions and also that sort of things, they definitely see that with the 15% tariff on imports, there will be to basically buy stuff in euro will be more expensive. So the automatic response is to sell euros and basically to go for anything else. There will be any other currency which doesn't have that sort of issue, although it's very vis-a-vis the dollar, but it's very, very difficult because you're not getting it with what is it, with the Japanese yen or the Mexican peso or the renminbi or even the Indonesian whatever rupee or all that sort of stuff. So basically the automatic reaction is to sell euros, okay, because it's more expensive to import goods from Europe, and so merchants immediately will sell euros. Exporters probably they will play around with they will not play around, they will have to understand which sorts of forward rates they would lock in when they are exporting merch and goods into the United States. It depends in how many days or months they are going to get paid from the importers. If there are those sort of transactions when there is a letter of credit or something like that, so the importer has 30 days to pay the exporter. But on the other hand, we know also that, for example, large multinational like automakers, BMW, Volkswagen, and Stellantis, and anything else, they have their production sites, and GM, they have their production sites in the United States. So they would ship around, as usual, auto parts and all what they need to assemble the vehicles. So there is not much of an import-export issue. And so we can presume, first of all, not presume, we can see from the weekly price action of the euro-dollar chart that basically sort of we have a kind of double top here, double top area. So the market has tested this area here, which is around 118-ish, 1790 something. And then you have a big reversal because evidently the euro was very much over appreciated vis-a-vis the dollar. Also considering other two factors. What are the other two factors? Are the interest rate differential. We know that the Federal Reserve still is around 4% with their federal funds rate, while instead if we know that the ECB is already down to 2%. So we see here, if we compare and contrast what are the swap rates for the dollar market, whether it's the month swap rate or the annual swap rate vis-a-vis the Euribor curve, we see that we have the Euribor rates are at the maximum in 12 months. They are pricing a 2% rate, and also the other duration, which is the other tenors, with 3 months or 6 months Euribor swaps. They have a normal bear steepening, so you have a normally sloping yield curve, which is convex to the upside, and so you have the 1 year, 2 year swap rates, whether it's the 3 months or 6 months, which are very much linked to the ECB interest rate, which is around 2% more or less. While instead the dollar, it has a much higher, almost double. There is more or less a 200 basis points spread between the dollar swap rates and the euro swap rates. So these are very complicated markets for interest rate swaps, currency swaps. There is all sorts of derivatives trading contracts, all sorts of hedging. So these are very, very important markets. And at the moment, we are in a situation when there are 200 basis points spread, at least for the 1, 2, and 3 year swap rates between the Euribor rates and the SOFR rates. Nevertheless, what that means is that it's cheaper for any institution, financial institution, or which operates within the euro area jurisdiction to borrow in euros. On the other hand, well, you can make this very simple arbitrage. You can borrow at Euribor 12 months for 2% and 2%, a little bit, 205 basis points, 2.05, and you can park it, then borrow at 2% and park it for 1 year at 3.9%, and then you'll have to hedge the exchange rate volatility. But net, you can pocket something between 180, 190 net interest rate spread gain by borrowing in euro and parking your money in a dollar money market fund. So that could be a easy thing to do. The thing is that when you change from euro to dollar and from dollar to euro, then because of the exchange rate volatility in 12 months time, then you'll have to hedge the risk of the exchange rate in order to achieve your let's say interest rate differential arbitrage. So you borrow at 2%, okay, and then you park it for 1 year at 3.9%, let's say 4%, and so you are netting a positive carry spread of 190 basis points. Then there is the exchange rate risk. But so we see, what I'm saying is that it's cheaper to borrow in euros. It's more rewarding to have a carry trade in dollar because the dollar yields more, yields 4%. And so there are all these dynamics which are in place when we consider the euro-dollar exchange rate. So if we have a recap, we have 15% tariffs, we have the interest rate differential, so there is around 200 basis points interest rate differential. Of course, it depends if we are considering we should leave alone the central bank rate. We need to see what are the Euribor rates, which tenor, which is the 3 months, the 6 months, the overnight Euribor rates, vis-a-vis the swap curve of the swap rates of the SOFR, the dollar market, and then you can understand, okay, I can borrow at 2%, I can lend at 4%, making a 190 basis points interest rate carry spread that would give me, 190 basis points on a certain amount, so $10 million. But then you'll have to, in that case, what is poignant, it's exactly the level of the exchange rate. When you basically go in and you borrow in euros, and then in that moment you sell euros and you buy dollars, and you basically did not, not that anybody can do that, but if a financial institution or any hedge fund, basically you take euros and then you have to see the exchange rate, what the market provides as exchange rate. You change it in dollar, you have a 15% premium on the dollar, which is exchange rate is 1.15, so there is a 15% premium of the euro over the dollar. And then so net to change into dollars, you park the money for 12 months, you are earning 4% in 12 months, then you have to change it back after 12 months, you have to change it back from dollar to euro. So according to what is the direction of the exchange rate, you may have made a net gain in your interest rate swap arbitrage, or interest rate carry trade arbitrage, or maybe you can even make a loss. So the exchange rate in this case is very important. And as I was saying, there are all sorts of financial system interest rate derivatives, which are market which is in the hundreds of trillions of euros or dollars. So these puppets here, the Euribor curve and the SOFR swap rates, those are very, very important swap curve, swap curve rates or interest rates. Those are very, very important for the big financial institution. Yes, so on the other hand, the other component, of course, is the euro-dollar exchange rate. And now we know now that the 15% tariffs on the euro basically are going to put a lot of selling pressure on the euro, for the euro to depreciate, in order that with the depreciated, devalued euro, then the exporters can mitigate the 15% tariff that they had to afford when they sell goods into the United States. So there is this balancing act. It's like that physics experiments when you have two vases with different levels of waters which are linked by tube, and then you know that basically some water goes from one vase into another until they find a balance. So in this instance, considering that there is a 15% tariff, then the exchange rate of euro dollar or dollar euro will be priced in order to absorb this excess cost on exports. And it's also a cost for American imports, because they have to absorb the cost, they have to pay the tax, and then that cost basically filters through the whole of the economy. And so the consumer in the end bears the brunt of higher prices. Also, probably there is less choice in the market, the choice, the variety of product, is less choices for products. There is less supply because the goods are more expensive. There are all sorts of dynamics which are then they go into play into the macroeconomic imbalances between the tariffs, the importers, all those businesses in the United States which are retail businesses. They sell agricultural food products imported from Europe, which can be Polish salami or German sausages or French wine, French cheese, Spanish wine, Greek olive oil. They will find an additional cost. So they will have to, of course, see their business, how they have to manage these additional costs, and that they will have to pass it through to the consumers, to the American consumers. And so those are the ripple effect that we will see eventually in the inflation numbers. Although today we have the balance of payment for the goods and services, and still the United States is running at the 80 something billion dollars a month in deficit in the balance of payment. So tariffs seem not to make a huge difference in terms of the primary accounts or the balance of payments in trades, goods and services, in import and exports. That means that it's a structural need for the United States economy, for the American businesses to import goods and all sorts of input factors for their production. And so with all this mumbo jumbo of variables and interlinked parts within the economy, then it's almost sure that we're gonna have some volatility in the exchange rate, especially if there will be some more announcement around the agreement and the tariffs. If something comes up, I don't know, if when the texts are published, and so the market will start to gather more of a clearer idea, or what are the industries and manufacturers which are involved in these things, the agricultural products, and so forth and so on. But for sure, there is a selling pressure on the euro. And the bar pattern that I put together. So basically, we flip around the pattern here. You see that basically we are going into that direction of retracing back the movement upwards, which was basically due to the weakening of the dollar. So the basically global investors diversifying from the US dollar in itself, and going into the pound or the euro or the Mexican peso, the Canadian dollar, the Swiss franc. Not so much in the yen, because the yen it's another kettle of fish. And so basically what's gonna happen, that will be probably a retracement. That's a way long no, I'm exaggerating. So from a chart point of view, I think most technicians will stop here. I don't like technical analysis because I'm not a day trader, so I don't really consider it. But basically, yes, I think most probably we're going around the 114 level, that's for sure. Because those businesses which are involved in the import exports of goods and stuff like that, they would run a course for the 114 or 114.50 forward. It depends if they wanted the 1 month forward, the whatever is the 3 months forward, what are their needs. But yeah, we are almost there. It's around what is 115, smack in the middle, 115 and a half. So it easily is gonna move towards the 114, which is here another point of what's called support, but it's basically when the curve of the exchange rate change, so the change direction, you have a point of the derivation into the whole thing. Sometimes you can find the derivative, sometimes you cannot find the derivative if you have a V-shaped pattern. When you have a V-shaped pattern, never place a bet in those areas, because the Greeks in the option chain, they're going to be very, very volatile. For example, here we have a slope, okay, like a gentle curve going up and then turning down. So we want to price the derivative here. Okay, so the market is able to provide a derivative which is you can find the derivative. Okay, but if I have here a V, well, it's V point here, because I have a sudden change and I don't have basically I don't have a curve, and so that means that the price action of the function is not continuous in this point. It's very difficult, if it's not, it's impossible. In mathematical terms, you don't have the derivative in that point, because it's an angular point. I don't know if I'm translating it properly. Like here we have a gentle curve, sort of, so we can price the derivative here. Okay, we can price the derivative here, going up and going down. When I'm saying pricing the derivative from mathematical basic concept is the option market. Okay, so I'm not a speculator, so I use bar chart to see basically. We want to price the derivative, then I'm referring to the option market. So what that means is that the delta, all the Greeks in the option chain, they behave more or less according to what are the implied volatility and the implied volatility skew. So I don't know how to explain, because I'm not an expert, but in very simple terms, here I have a point of non-derivation. Okay, I cannot find the derivative here because the trend changes direction suddenly. Okay, just it's for argument's sake. Let me say something. Like here, for example, you see you have a big you have a bearish engulfing here. This not a bearish engulfing. You have this small red candle here. So we are changing trend. We are changing direction very rapidly. From one big up day, we have then a sequence of a bearish sequence of repricing of the euro dollar. Now I think here this area it can be interesting, because probably it will make more sense if you allow me this mumbling and rumbling and tumbling. My tummy is rumbling. So okay, you see we have this. Okay, let me bear with me, cham, because I like to explain the thing as I want to explain it. This is big green, which is, okay, 1 week gain, the euro just goes gangbusters, okay? It goes from 109, it breaks up, it has a breakout moment, 109, breakout above 110, 111, 112, goes up to 2 cents and change, okay? So it's a big breakout moment. But then what happens is that, okay, all the market, all the people, they are all long euro. Okay, now we're gonna go, I don't know, rocket space. We're gonna go up and up and up, and then it changes. You have a sharp change direction. Okay, now if I draw it this way, okay, you have a cusp. Okay, so in that point, it would be very, very difficult in the market to price, to have a option chain market, active market, the Greeks, to price the option chain, to price it appropriately without a lot of volatility. And it's very fairly straightforward to understand, because when you have this big jump up, okay, probably all the option calls, all the calls above the 112, they had a lot of premium, okay, in those calls. and probably a lot of speculators, they were long euro 112.50, 113, 114. Somebody who's buying coal out of the money, and they may have paid a lot of option premium. But then what happens that immediately it changed direction, so that delta goes from the stars to the stall in a minute. Okay, so that's what I'm saying. When the market doesn't have a smooth change in direction in the curve, then you have a very rapid change in the Greeks, in the volatility of the option chain, and then all the premium that you have in a call on a put and you think you are in the right direction is gonna go flat. Basically, you're gonna be at loss in your option strategy. Okay, so that's why it's impossible to time the market, but my humble suggestion is never to find yourself in these points, which are a cusp or a peak or trough in the trend, and you don't have a gentle curve which goes like that, and then the option market can do its job and price the Greeks and the put and call and stuff like that, because this is the green candle. It's a wick. Then it comes Monday, the boom, the euro goes gap lower. You can imagine that all the people who were holding calls, they found themselves basically in a negative P&L. So the delta of their calls basically goes to zero, and they are out of the money, like without any chance of doing anything. Okay, so that's what I'm saying here. We have this V-shaped point. So basically, of course, that would have caused the delta or the call side of the option chain to rapidly gain option premium value in the option that you are going to speculate on. Okay, but in this instance, when we are I don't know why. No, okay, yes, I'm not very familiar with this chart as well. So here we have a curve. So the market slowly, week after week, day after day, has been able to price with more or less volatility the direction of the exchange rate. Now, if we want to waste some more time in the option chain, so we can see here. Yeah, okay. So the average implied vol is around 7.5. You can see 7.5, 7.9%. Only for the put, which are very far out of the money, implied vol it goes up around 10%. So it means that the market basically is also with implied volatility data. It tells you the market it somewhat expects some downside volatility. It's also the implied vol. The skew also for the call, which are out of the money, which are deep into the money on that side. So basically, the market it's pricing somewhat of higher volatility, and so basically the option market, the derivatives market, it's another way of understanding the how speculators, how financial institutions they are positioning, and what they believe is going to be the exchange rate going forward. Now, the currency pairs, I don't know, I'm not an expert in this, but I suppose that there is much more volatility in the the ODT market, like the zero-day expiration option market, where it is the S&P 500 or the various stocks which are in the United States. It's visible also for the implied vol. It's 7-8%, 10%. It's a tolerable implied volatility. Whether for stocks you can have vol of more than 20-30%, so we are talking about very other volumes of volatility in option chain for this kind of for stocks and the S&P 500 and stuff like that. But anyway, so what we can gather from the option chain, I don't know. I'm not an expert, so I maybe I could say something wrong. Nevertheless, I don't have any suggestion for what are possible trades in the option market. What also we can observe, for example, is the futures curve. So the futures, it's easier to understand, sort of, because with the futures or the forward rates, we are discounting the with the forward rates we have to bring also what is the ECB interest rate, the federal funds interest rate, and then do the proportion, and then we are pricing the forward. But nevertheless, we can see here, for example, that the futures curve is pricing an appreciation of the euro vis-a-vis the dollar. So speculators or financial institutions which are very much more have way more expertise than me. Of course they could speculate, probably they would sell the future contracts and eventually at some point start to buy the spot price. In what sense? Because if I know from now on going into the future that there is this 15% level of tariffs, probably the futures curve is a little bit mispriced, so there is some sort of arbitrage opportunity or going short the future, hoping that the price, the exchange rate basically drifts lower. Even if it goes to 114, then and you go short today in euro dollar future, you will make money for sure. Yes, and then at some point you could basically buy the spot price if it makes sense, sort of. But I think basically on a more general point, without going into the specific, if I know that there are this level of tariffs, probably I would eventually find out if there is an arbitrage, if there is actually an arbitrage opportunity in the futures market, and then I will short the euro dollar, some euro dollar future contract, which I find to be overpriced vis-a-vis the macroeconomic condition, the tariffs, and also what is the level of volatility in the market. And then never forget, you can find the data where to see how the hedge funds, the whole financial system, what is the broader positioning in this kind of instruments. I think it's CFTC. I mean, there is some, there are data that show basically if financial institution, if they are long or short euro, the volumes of contract, I mean, the people, I'm sure they know what I'm talking about. So, okay, on another sense, okay, we see here we were very close to the Fibonacci retracement. So let's have a wider chart of the euro dollar, like the monthly chart here. So basically, from in a chart standpoint, we can see, okay, we are here. Probably we are close to this Fibonacci level. We are going to retrace back down around 114, and I don't know. I've always been of the opinion, which is not a fact, but I've always been of the idea that the euro-dollar exchange rate, it's always been stable around 110, 1 euro 10. So there is always been this 10% premium for the euro on the dollar. I don't know. I'm not sure if there's going to be more volatility if the euro comes a lot under pressure. That depends also from the Federal Reserve interest rate part, but even if the Fed is going to cut interest rate, there's going to be a structural spread between interest rate differential that is going to be there no matter what happens. So we can argue that the 110 level, it's around here, around this, 110, it's here, 110, okay. So probably in 1 or 2 months, euro dollar will be at 110. So if you have the stomach and you want to go, I'm not suggesting you to do any speculation. Don't waste time and money around that. But usually euro dollar is a very boring thing, and it's the exchange rate. It's not 115. It's 1 and 10. That's it. 1 euro and 10 cents. That's so. That's what's all about the euro dollar market. That's why I did choose to do a video on the euro dollar, because it's very boring. Okay, so it has to be boring, otherwise it's not my bread and butter. So I probably will, by the end of the month or next week, we are already talking about euro dollar 114, and then probably it can push down as far as 110, unless from some strange reasons at some point something happens, and then the Deutsche Börse or in the Frankfurt, they find, okay, the machine is broken and you have a flash crash of the euro. I don't know. Anything can happen. You never know. And so somebody comes out and says, oh no, the machine is broken, the algorithm is broken. No, I'm kidding. So what can be useful to do? I can give you some useful point of reference, which are the euro dollar and also all other currency pairs, the standard deviation levels for even day trading. Okay, so here you see euro dollar price. We start the analysis of the price action of the time series from going back even to 2004, so even the whole of the euro stuff. And here we can see, okay, we have a 7-day rolling standard deviation of 0.0027. The 21-day, it's pretty much similar. So we are talking about 0.27, 0.28% rolling vol, which then annualized, it's 4.3 and 4.5%. Which that means basically that the euro, with these factors here, the euro moves around 30-35 pips per day. So basically you can easily structure some very modest, I'm not saying structure because it's a big term, but we can try to see what it means to have a 30 pips swing. Okay, sorry about all these lines. That's all the okay, let's okay, short position. Okay, let's say we want to sell the euro, and okay, 35 pips. All right, pips, welcome. Okay, 39, 35 pips. So it's very, very close here. There will be 115-ish, 115, 15, something like that. And then the stop loss equals 35, 30 pips, 36 pips. Okay, okay. So you can see here very, very easy. So this would be the range parameterized to the standard deviation, the 7-day rolling standard deviation, which in pips becomes around 30-35 pips, more or less. So the standard deviation basically is going to can be helpful in that sense. Although yeah, the other side means that it's oversold, so this will turn around. So let's say we want to, okay, let's see what is the long position. No, long position. Okay, like okay, if we want to collect this 35 pips on the upside, we want to have a take profit around 115.80 more or less, and a stop loss which will be very, very tight, around 115.12, 14, something like that, more or less. So that's sort of okay, just doing some wasting time in some stuff like that. But so only to give you a visual idea what is 35 pips. Why 35 pips? Because the standard deviation analysis that are made through the software showed me the level of 7 days and 21 days rolling standard deviation and the annualized standard deviation, which is for the euro, which is of course annualized 4.5%. Is very, very low volatility annualized, and that reflects that we are analyzing the data of currencies. Okay, so also here, if we go forward, we see the euro pound, the annual vol 4.6, 4.7, euro yen 3.7, 4.6. So we are in the range at 4%, 4.5%, 4.7%. The annual vol. Oh, this one is very, very low vol, which is okay. Euro Swiss franc. Euro Swiss franc is very, very low volatility. So it's 2% here, even 2.4% annualized. Very low vol. EuroCAD is a bit more. The 21 days annualized vol is 5.8%. So EuroCAD can be more interesting a little bit with a little bit more vol. And yeah, so forth and so on. I have included a lot of all the most known euro cross currency pairs. Euro Swiss krona, Singapore dollar also is 5.9, almost 6% rolling vol. Yeah, euro Mexican peso. No, euro. Okay, 5.9 is euro Swiss krona. Okay, euro Swedish krona. Sorry, it's more volatile. Singapore dollar, it's way less volatile. 2.9. Okay, Mexican peso. Oh, this one it's euro Noki, euro Norwegian krona. It's very interesting because the 7-day annualized vol it's 8.3%, 8.4%, while instead the longer, the 3 weeks, the 1 month vol it's 6.2%. So euro Noki, it's way more volatile in the shorter time frame, like rolling 7 days standard deviation, even up to 8.4%. It's very interesting. Euro Danish krona, no, there's nothing to see there. And yeah, the euro, euro, what is the Turkish lira? Okay, of course, that's the Indian rupee. And the South African rand, also a lot volatile stuff. Yeah, in the euro, the Polish currency, the zloty, yeah, okay. The Brazilian real. Okay, so, okay, wow, the Brazilian real is very volatile, 8.7 and 13.4%. It's a lot of volatility in there. So, euro dollar is pretty stable exchange rate. It's predictable. Nevertheless, we can have I'm sure that there's going to be more volatility, that's for sure. And probably the euro will depreciate because also in macroeconomic terms, the euro area, it's a very big economy, but GDP growth, it's a little bit less buoyant than the United States. So, and then there is this necessity for the euro area to export goods, and so for sure we are going to have a depreciation of the euro, which comes a bit timely because 118 it's very strong exchange rate, so naturally it will go to 114, probably will go back down to 110, and then there is room for speculation for sure. If you go short euro dollar and you can make some money for sure. That's not my my cup of tea. So okay, I can provide you some more data with that, but I want to choose what can be more relevant. Okay, seasonal decomposition of volatility, it's pretty much boring. Okay, let's see what we got here. Okay, ask for comparison. Okay. Just bear with me 1 second, and I'll find something interesting for you. I haven't prepared much the reading of. I don't have any script or stuff like that. Okay, we see here. Okay, let's see what is the auto-optimized conditional volatility. Okay, so the software says the best model for checking the historical conditional volatility of the euro dollar is the GJR Garch model, and it's a 1-2 model. Okay. Okay, so what do we have here? The p-values are not great. I don't know why it has chosen that one. So it's openable, this thing. Okay. Okay. Yes. Okay. No. Everything comes into the picture because it's a 1-2 model. So of course the alpha at one lag, it's statistically significant, and the beta at the second lag is the parameter that is statistically significant. And what we can see here that the beta is 0.79. So let's call it a 0.8 persistency in any conditional volatility shock. And the alpha parameter is 0.06, so it's 6% of the today's volatility or past volatility explains today conditional volatility, and the persistency is around 0.8. So basically, in this instance, the conditional vol measure, it can be very useful. Okay, the chart, it doesn't show any upward trend, although it's most of the euro or most of the Garch vol and the 20 days realized vol, they are at the maximum at one standard deviation, except for the 2008 period or 2011 period where we go to 5 standard deviation, euro crisis. That's another thing. So of course there is not much conditional volatility to expect. But nevertheless, we have some rough idea that, of course, there is persistency or clustering in volatility. So now we have seen the price action, the trend has reversed, and we can expect that conditional volatility, past conditional volatility in the past weeks, especially this week, which is a big red candle, it's a big bearish candle, past conditional volatility for sure is going to feed through into the ongoing volatility in this sense. Now, I don't think we're going to go as far down as 106. That would be a big move. Let's say we stay more around here, around these levels, which is 110. Yeah. I think we're going to, as far down as it goes, it will stop down to 110, and then basically, then we'll take stock from there if it goes to 110 and see. But nevertheless, this week volatility and the past week volatility, they are going for sure to fit through the euro dollar volatility in the coming days and weeks. So we can expect a reasonably downside. And if you want to make it simpler, okay, for those who are technical analysis believer, okay, we see here that the RSI has crossed the average yellow line, so we have a bearish trend, and then you can see that it's pointing down. Yeah? It's going, the trend is downward. Okay, so the past shock conditional volatility will fit through this week and the coming days and week conditional volatility. So also the price action, the level of the euro dollar exchange rate will be determined by the volatility that has happened in the past week, the volatility of this week, and then you will see the market positioning eventually for more buying more puts which are below the 115.50 level. They could buy the 114.50, the 114 level put option expiring in September. So that will be the volatility build up into the market for what is the derivatives market. And okay, we have here like a 6 cents premium for the 114.50 naked put strike, and the delta of minus 0.32. So for every we have a 32 cents change in the option premium when the euro dollar exchange rate moves by 1%, let's say. Then okay, the gamma, the theta, okay, the theta and the vega, they are pretty low, but these are expiring on the 9th of September, so we are not very close to the expiry date, so those of course will change. And yeah, the gamma is quite large gamma, so it means that the speed of adjustment in the delta whenever the euro dollar exchange rate continues to drift lower, so we have a downside pressure on the euro. Well, it means that the delta will increase quite sizably. Now I'm not an expert, I cannot do the immediate calculation, see the gamma and how much the delta is gonna the premium of the delta is gonna expand if the euro dollar goes down. I'm sorry about that, but anyway, so building the case for more volatility, maybe if you are a speculator, you would like, you can do your calculus, more accurate calculus, and see if it's worth to have a 115 negative put or 114.50 negative put, which expires by the beginning of September, and maybe you will earn some money, because basically what we see at the 114.50, the delta is minus 0.32, but the delta of the call is 0.60. So basically, the more the euro dollar will go from 115 towards 114, the delta of the call, which is 60 cents, will compress, and that premium will go basically on the other side, will expand the delta of the put option. Hold on 1 second. And so the option market can be a good diversifier for understanding, for gathering the level of volatility of banks and financial institutions, and also currency traders, so where they see the market going and how the delta and implied vol will move in the next days. And okay, then the spot market, it's or the futures market, those are the other levels of speculation, or where to find the euro dollar prices also in the futures, etc, etc. So we were checking here on the Garch models. Okay, of course I have the Garch models iterated for all these currency pairs, from euro dollar down to euro Brazilian real, Singapore dollar, anything that you like, Aussie, Loonie, Euro Aussie, Euro Loonie, Noki Stocky, anything that you would like to know about the euro currency market. And okay, so same iteration of the Garch model. So let's see what are the, of course, when we ask for having a forecast of rising volatility, of course the software gives us a rising volatility. So that's the 633-day volatility forecast. And of course we can see here that we have marginally rising conditional vol, whether it's euro Aussie dollar, it's euro Brazilian real. I don't see what kind of chart is that. So even okay, problem in optimizing converging. Okay, so nothing to see here which is very relevant. Okay, euro Hong Kong dollar. So I don't know, these are just simple charts showing some sort of rising condition volatility, but you can see here the parameters are very, very, very tiny. Okay, so let's go forward. Okay, so okay, yeah, here probably it's useful to have a broader idea. So in fact, the average volatility you can see here is very, very little, what is extrapolated from the time series analysis through the conditional vols. The 63, is that the 63 days volatility forecast? Okay, so yeah, the most volatile, of course, is euro Brazilian real. Let's pull up the chart. Okay, bear with me one second. I want to understand what is all about this Euro Brazilian Real. UBRL. Euro. Oh, okay, let's go for something exotic. Let's see if we find it. Sorry about that. Oh, okay, yeah. That's this puppet here. Let's see what's that all about. Why it's so volatile, this thing. Brazilian economy. It's an economy that's been growing organically very fast. It's a very good country. So okay. Oh, that's very interesting. So we can see here. So basically, we have, of course. Oh, that's no. I don't need the dollar Brazilian real. I need the euro Brazilian real. Do you have it or you don't? Either you have it, not found. No, not in the economy. Forex. Here we are. Okay. Here we have it. Okay. Finally. Okay. So okay, that's a long trend of euro strength here. Very long trend of euro strength, sort of. Okay. And I don't see, okay, the volatility, so we picked here in 2021 at 7. Here we are 6.8. Today it's 6.4. So rising volatility, of course, it's steady long euro. So this will be a very popular carry trade. Mostly you would have been long euro for a long time because we see the exchange rate, let's say from 2010, it's gone from 2.2 to 7. So you have a long, many years of long euro vis-a-vis the Brazilian real. But this past volatility here, we see since 2021, the Brazilian real is showing some sort of strength and in the price action, and that eventually could mean that we will have an adjustment in the level of the exchange rate between the euro and the Brazilian real. Probably we'll have some sort of strengthening of the Brazilian real. That's basically, it's very interesting to consider in a macroeconomic framework. So what happens is that the euro area has this tariffs barrier towards the United States. What you want to do in a business environment is to diversify. So you want to find new markets in Asia, or you want to find new markets in the Mercosur. So that's why what that means is that if euro area industries, they want to export more stuff into Brazil, of course they would make sure, not that they can do it, but what happens is that the euro will tend to weaken, to depreciate, in order to give more space, more purchasing power to the Brazilian real. And that could be also, that can be an explanation. It depends, of course, if there are arrangement in place between Brazil and euro area to have a direct trade in euro. So we are bypassing the dollar, and so businesses in Europe will accept Brazilian real, or they will accept some sort of financial products, which will be forwards contract when a payment from Brazilian real in euro will be cleared. So it depends. These are all nuances which to me are not of my knowledge in this moment. But what can explain the average higher volatility in euro Brazilian real, but also in historical terms, going forward, is that there can be the euro would need to depreciate going lower in order to make sure that importers from Brazil would have a sort of larger purchasing power in acquiring goods from and services from the euro area. So that could be an interesting thing to monitor in a sense of macroeconomic sense. Not there is no way anybody can trade euro. I have no idea what to do with this thing. But I will see. I want to see in the future all these other exogenous markets, which are not the big known market, which is the United States or China. I want to see how the euro area will diversify with the other countries, and especially with the Mercosur countries and all those kinds of FTA agreements. In any sense, we can see here with this summary table that the average vol for Brazilian real or South African and Turkish lira, it's around 0.9 or 0.6, 0.5 on an average 7-day rolling average, and yeah, also on a 21-day rolling average, as we saw before. But nevertheless, we can have a an idea. We can see, can compare the data. We have also here the model distribution, what is the P and Q, okay? And even if it's a Garch or any Garch, but we can see here euro pound, there is no volatility at all. So the exchange rate between the euro and the pound, because there is a continuous, there are continuous financial flows between Paris, Frankfurt, and London, or Milan, or Madrid, and stuff like that. So there can be so much volatility in the level between the euro and the pound, but there is a lot more volatility for emerging market currencies, which we see here: Brazilian real, South African rand, the Turkish lira. It's it's a null. A different thing. It's another category of currencies. And yeah, the Indian rupee, also the Chinese yuan or the Mexican peso already starts to be a lot more stable in the same basket of the Australian dollar, the Norwegian krona, and very close to euro dollar. It's a lot more volatile than what is the Swiss franc or the pound or the Polish zloty and stuff like that. So we have a middle of the pack, around at 0.4447 something percent vol, and the top is the Brazilian real, almost 1% rolling average volatility. And so those are also data which are very interesting to gather. Bayesian posterior mean distribution, let's do complicated of a thing. Okay, here that's another interesting fact. Okay, so if we run an OLS regression, we can see, we can see here the equation. It's very euro dollar, the exchange rate plus the coefficient and the euro pound exchange rate. So we can see what is the R squared and the slope. That's very funny. So you see the R squared, it's a very almost to no correlation, so it's very close to zero. Also the first difference in linear regression, and the first difference, the slope is quite a bit larger. Okay, and yeah, we see here the clustering between the euro dollar and the euro pound exchange rate. Yeah, nevertheless, we can run some OLS regression. We see that basically the R squared, they are close to zero, so there is not much correlation. When instead euro dollar, euro yen, the R square is 0.29, so we are 29% of euro yen volatility explains euro dollar volatility and vice versa. So there is some sort of correlation between euro dollar and euro yen, and that basically derives from the fact that dollar yen is a very liquid currency pair, and it's very important also in the funding market. So of course there is a triangle here between euro, dollar, and yen, which makes euro dollar and euro yen a bit more correlated in that sense. Okay, euro Swiss franc 0.10, very negligible, but are negatively correlated. We see that the red line slopes down, so there is a negative correlation. So if euro, okay, yeah, and that's very natural, because basically what happens that the Swiss franc is a safe haven currency. So whenever the euro basically you have a flight to quality into the Swiss franc, that it means that euro dollar probably is going down. So that's why they are inversely correlated. No, okay, no. That's no. In that sense, I may be saying something wrong, because euro dollar vis-a-vis euro Swiss franc. So what is the commonplace explanation is that when you have money flowing into the Swiss franc, you have money out of the euro, and in that sense also euro dollar would be going would be negative in that sense. Also the dollar will gain strength, but that's to see. Oh yeah, we have very, oh okay, so euro dollar, it's very much correlated, not very much, 0.55. It starts to be a consistent, it starts to be a good parameter with the euro Australian dollar, and they are positively correlated. So whenever the euro is appreciating against the Australian dollar, it's also gaining against the US dollar, and that explains 0.56 or 56% of the correlation between the two cross currency pairs. Here we go even higher, and of course because it's the Canadian dollar, so it's the same geographic area, and strength in euro Canadian dollar explains strength in euro dollar for a 0.7, like 70%. Okay, euro New Zealand dollar, it's a bit lower, 0.39, but still they are correlated into the same direction because they are all dollars, Canadian dollar, Australian dollar, New Zealand dollar. Whenever it's the dollar in all these flavors, then they are correlated. Euro, okay, Swiss krona, they are not correlated at all, very close to zero. There is no relation between the two. And then we have Singapore dollar, and there is a very high correlation in this instance. Mexican peso, there is no correlation. Euro Norwegian krona, there is some sort of correlation, although the first difference is negatively correlated. Okay, Euro Danish krona, Hong Kong dollar, wow, that's crazy, full correlation. That's very interesting. The level of residual, there is something fishy around this thing, I don't know what. Okay, yeah, there is no slope, so the data fits completely the regression line. But there is the level of residual, it's a bit wider. Okay, I would like to check more closely this Hong Kong dollar and also the Chinese yuan. There is some sort of very strong correlation with euro dollar. So very interesting. Euro, Turkish lira, you see the blue dots, all this scattering around, so there is not the level. Oh, that's Indian rupee, very strong correlation. Okay, also the South African rand, it's 0.55, there is correlation, and then there is an inverse correlation with the Polish zloty. Okay, that's very interesting. That's very, very interesting. That's very, very, very interesting. So it means that basically when the Polish zloty gains strength against the euro, vis-a-vis the euro appreciates towards the US dollar, so they are inversely correlated. Okay, so when euro Polish zloty goes down, euro dollar goes up, so it means that, okay, yeah, that the dollar depreciates. Okay, Brazilian real 0.22. Okay, so these are all the OLS regression. Of course, we have, let's see if yesterday was a VAR day. Okay, yes, yeah, we have, yeah. So we have 1.23%, it's a VAR 97.5. So actually, if we go back to, I think, yeah, this big candle here, this one here, it's more than 1% move to the downside. It's for sure, it was here we have a 2.5% probability that one day euro dollar move to the downside is larger than 1%. We have the parameter here, it's around 1.2%, which is probably very much in line with the yesterday market volatility. And the very large move, it's a 3.1%. That can be as large as 5.2% with the expected shortfall levels. But we saw that only during the euro crisis. You can see all the blue clustering of daily returns. They rarely spike above these VAR thresholds or peak over thresholds and stuff like that. So they are very, very much contained because of course it's exchange rates, so these are currencies. Okay, that's another way of seeing what is the tail distribution of the tail risk in euro dollar. You see here, yeah. It's another way to see the tail risk distribution. It just gives you one tail risk parameter, and it's very, very large. And effectively, it says, okay, the threshold is 119, which is, again, it's in line with the yesterday volatility, around 1.2, 1.10%. And once we have the 1.2% daily vol, which breaks through, the market breaks through that level of volatility to the downside, of course, then we are going, there is volatility risk building up into the market, because then, of course, what changes is that the derivative market starts to kick in, and you have all the speculation and people that start to buy put, which are out of the money, or they start to deploy all the option strategy or put spread or butterfly, collar, straddle, whatever you you want to use. But nevertheless, the volatility in the derivatives market starts to be amplified to the downside, and so that's why you start to go towards the large daily moves, which are way in excess of minus 1.2%, minus 2%. If 3%, it's well, in that case, the market is selling off. The market, also the stock market, is tanking. And basically, we go now. First iteration, we start to put the tariff in, but then we have some sort of linear regression, a very simple model, and you will see that the model, the results are very out of the ordinary. Of course, this will need an ARIMA forecast with some sort of exogenous variable to see the autoregressive trend and stuff like that. But basically what says here, we have the actual euro area, model prediction, the green line before the tariffs. So the baseline projection is here, this black dot level. With tariffs, even it brings to 0.95, so euro dollar below parity. And nevertheless brings a projection, baseline projection of 105, which in any case will tell us that the euro now, what is the market price of euro dollar, probably the euro is a bit over appreciated in this instance, but it's a lot so estimated depreciation of minus 10%. It's a very rough model. There is no very much sophistication in that, I mean, a lot of the euro strength, it has been due to the US dollar depreciation, but for sure, we're going to go towards 114 and 110 level. These are very, very, very important exchange rate levels. We've seen that the conditional volatility, it tends to build up into the market, and so it carries forward into the following periods. And here we can see also, we can appreciate three different levels of volatility. So we have low vol, medium vol, high vol. The model runs through all the time series, and it tells you, okay, you have 1,938 observations, which are daily returns. So it's 1,938 days in a low vol regime, which is a 0.42% vol. And the alpha and the beta, those are the parameters of the Garch model. Then you have a medium vol periods, which are 1,867 days. Average vol is 0.551%. And then you have high vol periods, 1,813 observation, which is 1,800 days, 1,800 days. And we see here vol, it's 1.02%. So that's high vol regime, high vol level in the market. It's very, very, very similar to these levels that we are seeing here. Okay, so I can take this data and have a very clear picture in what kind of volatility levels we are talking about, and for sure there will be more volatility in euro dollar going forward, and the euro will tend to depreciate more. What's going to be interesting, of course, it's when basically we are going to break through the 115 level, which is here. Okay, so we are here. Okay, this is this black line is the 115 level. Okay, I'm sure whenever the market, we have pinched today, this week, no, it's today we have pinched 115, and then the market has just gone back a little bit. You see the body of the candle, we are going back up, so we're getting closer. So whenever we have a breakthrough, the 115 going down, okay, whenever the market breaks through this level, then volatility is going to be much higher, okay? Because from 115, it's very easy that we go to 114, and then it's much easier that we go back down to 110, okay, towards this level here, okay? So I'm pretty sure that there will be more volatility building up in the coming days and weeks. And so we are, because here, yesterday was a very big down day for the euro, more than 1% daily loss in the euro dollar. I know that I am in a high volatility environment in the market for what concerns the euro dollar daily returns. And I know that I have a 5% alpha and a 94, almost 95% beta. So that means the past volatility shock, according to the alpha parameter, which is 0.05. So 5% of past volatility shock are propagate into the following periods. In this case, is conditional volatility. Now, conditional volatility, it's different from the daily standard deviation, because the conditional volatility, because it's historical conditional volatility and you have a regression, So it's a period t or a period t minus 1, t minus 2, etc., etc., etc. Then there is also the time component, so it has a stochastic component in the modeling of the equation of the Garch model and stuff like that. And so that's why it's another kettle of fish compared to the normal standard deviation, because there is the time component. Now the beta is 0.94 or 0.95, so 95% persistency in volatility, and so I do expect more volatility in the coming days. Okay, Garch volatility model, autocorrelation of square residuals, only at the first lag. Okay, and these are very interesting levels that I can basically go and check. Okay, so now Europe. Okay, what I can see here, for example. Okay, see the performance. Okay, in 1 week, euro dollar 1 week, but today is Tuesday, so in a couple of days euro dollar is minus 1.26. so this minus 1.26, it's a var 97.5. Yeah, okay, let's go back, let's go, and it's all I've said up to now. Okay, so we are past this threshold, 119, in the left side of the tail distribution. So we are in a tail risk situation for euro dollar, for the euro in general, okay? Especially for the euro dollar, because the tariffs are coming from the United States. We see that basically north of 1% in daily loss, it's either a var 95 or a var 97.5. And so taking all the data together, we are in a tail risk environment. I know that I like to talk about this stuff because I like when there is volatility. Otherwise, if you are a day trader and there isn't any volatility, we are basically wasting our time. But nevertheless, the data confirm that what the market confirms what our data tell us. Okay, where is okay? So this week, euro dollar is already down minus 1.2% exchange rate. Okay, and okay, also pound dollar is down 1%. Okay, so we are in the high vol situation and the tail risk situation for the euro dollar. Okay, so now euro pound, let's see what is the performance this week. Euro British pound, we are 0.25. Okay, so it's not the high vol regime, we are in the low, very low vol regime. Okay, so euro pound, leave it alone, there is no problem with that. Okay, now euro yen, which is interesting, we are in the low vol regime, already see vol 0.47%. We see the performance this week, 0.41, 0.45 to the downside, depreciation of the euro, but still it's a low vol environment. What is very volatile is the US dollar, and we see also in the cross between the pound cable, the pound and dollar, because we are moving around 1%. And in the month, for example, in the month of July, the pound has depreciated minus 2.77%. That's also on the back of very strong pound compared to the dollar, 1.34, 1.35, and also because of tariffs going into the US market. Now, if we see here the euro vis-a-vis all the other currencies, we see that there is no volatility, or the euro Norwegian krone, it's a bit more vol, 0.83% in the week, so there is more volatility. And yeah, the Australian dollar, so we see here how the correlation between the euro dollar and the Australian dollar, it works very well. Because euro dollar this week it's minus 1.26% on a carry trade level, with a correlation trade level. We see that euro Australian dollar it's minus 1%. So eventually, if you are a euro trader, you know that when you can be short euro dollar, almost for sure you can use the correlation with euro Aussie dollar and you can short euro dollar in the same proportion. Okay, if euro dollar goes down 1%, euro Australia dollar will go down minus 0.9%, but we are in the same ballpark range. Euro loonie, Canadian dollar, it's a little bit less volatile, but still has the same direction, same correlation level. Okay, so that's interesting to see how in the market, of course, the trading of the currency behaves exactly to what the data shows me when I do the OLS regression and I see the correlation between those pairs, and I want to see in which kind of... now, let's see here, okay, euro Australian dollar, euro Aussie dollar. Okay, we are in the high vol level situation, because the vol is 0.85%. Now, in a couple of days, euro dollar has gone down by minus 1%. So we can consider this as a high vol situation. So if you are a day trader, you want to have an eye on euro dollar and the other eye on euro Aussie on euro Australian dollar, or in other words, you want to have an eye on the cut and another eye on the fish that you're frying, because you have to be careful when you're frying fish. You have to be careful if there are cuts around, and you need to keep an eye on both at the same time. Also, euro Canadian dollar, we are approaching the high vol regime because we are talking about 0.70, 0.7%, and there is autocorrelation in square returns. Okay, these are all very interesting stuff for the nerd quant data scientist. Okay, so what else we got here? I need some more. I need more and more. Okay. Yeah, okay, this confirms basically historical volatility. What are the low, medium, and high vol regime? Okay, and we see, okay, the standard deviation is 1.19%. So we are in the high vol situation for the euro dollar. Okay, that's very, very interesting. Okay. Okay, we have, okay, not enough data. I'm sorry about that. Regime reversal probability, we don't have enough data, but basically here there is a snapshot of the current vol between the cross pairs and the forecast vol. So, okay, current vol euro yen is that. There is a somewhat of darker orange, so higher vol for euro yen, higher vol euro Mexican peso. I don't think that reflects very probably the market, but that's a fancy chart made of colors so that we can see what the forecast model gives us. I will leave it as it is. I don't want to waste time on that. It's just a chart snapshot of what is the probable thing coming up. Okay, so now what we have a couple of things to see very briefly. So we are comparing two trading strategy. One is going to the Z-score and the mean reversion, the other one the buy and hold. Okay, so basically when we take the distribution of daily returns, we standardize it as for a mean reversion. Okay, so we calculate what is the average level of exchange rate in euro Australian dollar in the past 20 years. So we use a mean reversion method. And what is the strategy that would give you a higher return? In that case, the pink line, which is the mean reversion method, it provides higher return than the buy and hold. So you sit long euro dollar, you earn less than trading according to a mean reversion strategy. So what that means is that the exchange rate deviates above the average value you want to sell, and if it undershoots, if it goes below the average exchange rate level, you want to buy, because that's the mean reversion. That is, you always converges to the average. Euro Brazilian real, the mean reversion strategy is very, very profitable, cumulative returns, but those are spread over 20 years, so there is not much to run home. Euro yuan north of 20%. Okay, let's see for that's Indian rupee or north of 10%. So for most of all the cross currency pair, the mean reversion strategy, it's the strategy that provides better return, except for the New Zealand dollar. And here we have a huge divergence, Singapore dollar. Okay, and the Euro Turkish lira, and I suspect also Euro South African rand. Basically, if you go long Euro Turkish lira, you make loads of money. Mean reversion strategy, it's more profitable for Euro dollar, of course. And Euro South African rand, basically you need to sit long and euro vis-a-vis South African rand, and we have a summary of the profit performances. And those are really astonishing. Total returns 500%, 120%. It's a lot. So we can compare the strategy annual return. Okay. So the chart is the annual return. So the total return over 20 years, it's a lot more. So that makes it's very interesting. And of course, the strategy is also an annual volatility, so there is the risk of taking some large loss. Okay, so what performs better is the Indian rupee and the Mexican peso, using a mean reversion strategy. Also the Brazilian real. Those can deliver a north of 500 total return, an average 10% return on year. with some volatility, of course. Instead, basically, if we use the buy and hold strategy, just sit long the euro, you have a lot of negative returns, annual negative returns on average, because basically you're just sitting long the euro, so there is no buy hold volatility, buy hold sharp. Okay, there is not much that it's changing in the trading strategy. So the mean reversion strategy here, this one, is very, very interesting. And the Mexican peso and the Brazilian real, also the Indian rupee, they seem to be very interesting. But also the euro dollar mean reversion strategy, can be interesting. Can be interesting somehow. Okay, so let's see if there is anything else we can deal with. Yeah, okay. So very easily we see here the correlation of annual returns. And basically euro South African rand or euro Turkish lira, you see with very dark green. You just sit long euro Turkish lira, you will have an average 20% return per year, and the 0.99 sharp ratio top euro Turkish lira. Also the South African rand is very profitable in that case. So it's been a huge pleasure to provide you all this interesting content. Remember, okay, if we are breaking below the 115, I do expect a lot more volatility going into the market, and I do expect the euro dollar 114 and 110. And thanks a lot. Just drop a like, and as usual, I'm sure I'm doing an outstanding job for the YouTube algorithm. And see you to the next content.